Have you ever defended a coin in a conversation and afterward realized that you weren't actually defending the coin? You were defending the version of yourself that bought it. Because if the coin is wrong, you're wrong. And being wrong is harder to accept than losing money. So you keep buying. You keep posting. You keep holding. Not because the trade still makes sense, but because the alternative is admitting something about yourself you don't want to admit. Welcome back. This is the final episode of our Trading Psychology series, episode 10. Over the last 9 episodes, we've covered the surface level emotions of trading. FOMO, revenge trading, hopium, overconfidence, cutting winners early, analysis paralysis, comparison, addiction. Today we go to the deepest layer, the one that quietly drives all the others. We're talking about identity and ego in trading. Quick explanation. For anyone hearing this term for the first time, identity-driven trading is when your trades become entangled with your sense of self. It's not the same as having conviction. Conviction is rational confidence in an analysis. Identity is something else. It's when I think this coin will go up becomes I am a bull on this coin. Notice the shift. The first statement is about the coin. The second is about why. Once your identity is in the trade, exiting becomes much harder than the math suggests. Because exiting doesn't just mean losing money. It means losing a piece of who you thought you were. And humans defend identity far more aggressively than they defend capital. Let's start with how identity gets entangled. It happens through a specific sequence. First, you take a position. Maybe ETH, maybe BTC, maybe a smaller altcoin. Then you do research to justify the position. Reasonable so far. Then you start sharing the thesis with friends, in Discord, on Twitter. Each share locks the position deeper into your identity. By the third or fourth public statement, you're not just holding the coin. You are the person who's bullish on the coin. The two have merged. Now if the coin starts going down, cutting it doesn't just mean losing money. It means walking back what you told everyone. It means admitting to your community that you were wrong. It means watching your guy who saw it status quietly evaporate. So most traders, faced with this, hold, even when the math says exit. Because holding preserves identity. Exiting destroys it. The position becomes a hostage. There's a neuroscience layer to this too. When you publicly commit to a position, your brain's default mode network, the part that handles identity and self-narrative, starts running the position through. It becomes part of your sense of self. Brain scans of people who hold strong beliefs show they treat challenges to those beliefs as physical threats. The same neural regions that activate when you're being attacked physically activate when your trading thesis is challenged. Your brain literally treats you were wrong about ETH as you are under attack. This isn't a flaw of any particular trader. It's how human brains work. But understanding it gives you a chance to override it. Most traders don't override it. They hold. They double down. They post more justifications. Because the alternative, letting the identity dissolve, feels like death, even though it's just letting a trade go. There's a second mechanism worth knowing: sunk identity. We covered sunk cost in earlier episodes. The trap of holding because you've already lost. Sunk identity is a deeper version of the same trap. You've already told people you're bullish. You've already built your online presence around the thesis. Walking back means undoing identity construction that took months. The more public the position, the higher the sunk identity cost. A trader who tweeted once about ETH can quietly exit. A trader who built their entire profile around being an ETH maxi cannot exit without erasing their public self. So they don't exit. They start adjusting their stories instead. Maybe ETH didn't pump like I thought, but it's still the best base layer. Maybe the timeline shifted. Maybe accumulation is happening quietly. Maybe the chart is fake. Each story, adjustment is a small lie to themselves to protect the identity. Over time, the lies stack. The trader becomes someone they wouldn't have recognized 2 years ago. This is one of the saddest patterns in trading. Not because the money is lost, but because the trader has lost themselves. Let me describe 3 specific patterns of identity trap trading. The first pattern, the maxi identity. You become known as the person who believes in coin X, maybe ETH, maybe Bitcoin, maybe Solana, maybe XRP. Your profile picture changes to a logo. Your bio mentions the project. Your followers expect you to defend it. Once you're publicly a maxi, you can't realistically rotate to a competing asset, even when your analysis says rotate. The identity is the prison. Most maxi accounts can't change their positions because their audience expects them not to. The audience becomes a constraint on your decision-making. The second pattern, the public prediction. You make a specific call. ETH to 8,000 by end of year. Now you've staked your credibility on a number. If you exit before 8,000, you've conceded the call. So you hold past the point where the chart says exit. You hold past your stop loss. You hold until your account is meaningfully damaged. All because the public prediction created identity, stakes that pure analysis wouldn't have created. The third pattern, the defended thesis. You bought a coin for specific reasons. The team, the technology, the narrative. Then the situation changes. Team leaves. Tech disappoints. Narrative fades. The trade should be exited based on new information. But you've already defended this thesis multiple times. Each defense, you came back and verified. Yes, I still believe this. By the 5th defense, the defending is the identity. You're not holding the coin because you believe in it anymore. You're holding because not holding means all those defenses were wrong. And admitting wrong, after defending publicly, feels like more than the loss can justify. There's a cultural amplifier in crypto specifically. The tribe-based identity system. Crypto markets organize themselves into tribes early. Bitcoin maxis, ETH community, Solana believers, XRP army. These tribes function like sports fandoms, with loyalty tests. If you sell your tribe's coin during a drawdown, you're a paper hand, a weak hand. The community brands you. Compare this to traditional markets. A trader who sells Apple stock isn't betraying a tribe. They're just selling Apple stock. In crypto, selling can feel like leaving a faith. This is why the same trader who would happily rotate Apple to Google can't bring themselves to rotate ETH to sell, even when the analysis says rotate. The identity isn't in the position. It's in the tribal affiliation. And the tribal affiliation is enforced by the community every time a price drops and someone asks, still holding? The pressure is real. The trades it produces are predictably worse than the trader would otherwise make. There's a leverage angle that makes identity trading lethal. In spot trading, identity-driven holding costs you opportunity. You miss rotations. You take longer to recover. But you don't blow up. In perps, identity-driven holding kills accounts. Because the same identity that makes you hold spot makes you add to a losing leveraged position. The thinking goes, I can't be wrong on ETH. So if it dipped, that's just a buying opportunity. So I'll add at the lower price. With leverage, the position grows. The conviction strengthens. The leverage stacks. The price keeps dropping. Now you're in a position 3 times larger than your original size, all at higher leverage, fighting the chart. The liquidation comes. Not because the analysis was wrong, because the identity wouldn't let the analysis be wrong. The leverage was just the multiplier on the ego. This is how some of the most public, most confident, most followed crypto traders blow up overnight. The position itself wasn't the problem. The identity defending it was. There's a quieter version of identity trading that's worth naming. Because it doesn't blow up. It just slowly erodes. It's the long-term hold that's no longer a thesis. It's a memory. You bought a coin 3 years ago. You held through one cycle. The thesis at the time was reasonable. The cycle ended. The thesis evolved. Most of what was true then is no longer true now, but you still hold. Not because you reviewed the position, because reviewing the position would require admitting it stopped making sense at some point. So instead, you just don't review. You let the position sit. Quarter after quarter. You're not really invested in the coin anymore. You're invested in not having to face the decision. This is identity trading without the drama. The maxi who blows up at least gets a forced resolution. The quiet holder gets a slow drift. A position that does nothing, that they can't bring themselves to close, that quietly pulls their capital out of compounding for years. If you have positions older than 2 years that you haven't reviewed, you may already be in this version of the trap. The fix is simple but uncomfortable. Schedule a review. Pretend you don't already own the position. Ask, would I buy this today with what I know now? If the answer is no, the trade is done, whether the identity is ready or not. There's an after effect to identity blow-ups that's worth understanding. The identity collapse. When the position finally gets liquidated, or the trader finally exits at devastating loss, the identity that was attached to the position also dies. This is sometimes called a trading bottom. In psychology terms, the trader who built their online persona around being a coin maxi loses both the position and the persona. This collapse is painful, but it's also necessary for the trader to ever rebuild correctly. Because the new trader who emerges from the collapse usually understands something the old trader didn't. The position is not me. The thesis is not me. The trade is something I do. It is not who I am. This shift in self relationship is the single most important growth a trader can experience. But it usually doesn't happen without going through the collapse first. Many pros will tell you their best trading came after their worst blow-up. Because the blow-up forced the identity separation. The trader who hasn't blown up yet often hasn't completed the separation. That's not a recommendation to seek a blow-up. It's a recognition that the separation is one way or another required. So how do you train yourself out of identity-driven trading? I'll give you 3 practical rules. 1. Keep your identity outside your positions. When you take a trade, refer to it as the trade, not my trade. When you talk about a coin you own, say I'm long X right now, not I'm a bull on X. This sounds like semantic. It isn't. The words you use to describe your positions program how your brain treats them. My trade creates ownership. The trade creates distance. Distance is what allows clean exits. 2. Avoid public commitment to specific calls. Don't post price targets. Don't claim conviction levels. Don't build a public profile around being right about any single asset. This is hard because trading culture rewards exactly the opposite. The traders who get attention are the ones who make bold public calls. But the trader who gets attention isn't usually the trader who survives. The trader who survives shares less publicly than they think. Their positions stay private. Their decisions stay private. Their identity stays untouched by the trade. This shift alone protects against most identity traps. 3. Practice saying, "I was wrong," out loud. Find a trade you took that didn't work. Say out loud, "I was wrong about that one." This sounds trivial. It's surprisingly difficult for most traders. The practice matters because if saying, "I was wrong," feels uncomfortable to you, that discomfort will affect your trade exits. Every time the discomfort wins, you hold past the exit. Every time the discomfort loses, you exit cleanly. The more you practice the words, the easier the exits become. This is one of the most underrated psychological exercises in trading. There's a flip side worth knowing. Professional traders have a specific phrase they use internally and with each other. The thesis is dead. When new information comes in and the original thesis no longer holds, the pro doesn't argue with the new information. They just say, "The thesis is dead," and they exit within seconds, because their identity wasn't in the thesis to begin with. They had a thesis. They tested it. It didn't hold. Move on. The retail trader can't do this because the thesis was their identity. The pro can do this because the thesis was just a piece of analysis. This separation between trader and trade is the highest skill in trading psychology. It's also the rarest, because everything in trading culture pushes traders toward identification, not separation. The pros who maintain separation usually do it through conscious practice, through journaling, through community with other pros who model the same separation. It's not automatic. It has to be trained. So to summarize today's episode and the entire series, identity-driven trading is the deepest layer of trading psychology. Underneath FOM, revenge, hopium, paralysis, comparison, addiction, there's almost always an identity that's quietly attached to the position. When you can separate yourself from your trades, the surface level patterns become much easier to manage. When you can't, you'll keep falling into them in different forms year after year. The 3 practical rules: keep identity language out of position discussions, avoid public commitment to specific calls, practice saying, "I was wrong." Underneath all of it is one core realization. You are not your positions. You are not your win rate. You are not your account size. You are a person who takes trades. The trades come and go. The person remains. The trader who internalizes that distinction can trade for decades. Through every market regime, through every losing streak, through every win streak. Because no single trade can threaten an identity that isn't in the trade. That's the foundation. Everything else we covered in this series builds on it. This wraps up the Trading Psychology series. We started with the lie that more strategies create profitability. We covered the most expensive emotional patterns: FOMO, revenge trading, hopium, overconfidence, cutting winners early, analysis paralysis, comparison, addiction, and finally identity. If you've made it through all 10 episodes, you have a framework most traders never develop. The framework alone doesn't make you profitable, but it makes profitability possible. Without this layer, technical knowledge usually fails in execution. The next series will go deeper into specific psychological territory. Tilt, drawdown, survival, profit, taking discipline, news reaction, burnout recovery. Topics that emerge AFTR. A trader has mastered the basics in this first arc. Appreciate you all for listening through the entire series. If this helped you, make sure to subscribe and share the series with someone serious about trading psychology. The work doesn't end here, but you have the foundation now. And I'll see you guys in the next series. Start trading now on Mosey Finance. Trade perps everywhere with one dashboard. Link in bio.